Let's take the discussion on markets forward with Siddharth Vora, who is joining us from Prabhudas Lilladher. He manages the PMS fund at Prabhudas Lilladher. Siddharth, afternoon. Thank you so much for your time. Uh, this is the first time you are joining us on this show, so good to have you. Tell us, first of all, what's your prognosis of the market valuations right now? How are you approaching the market?
Perfect. So what we do is we look at valuations from a quantitative lens. And I think 1 month back, we had 63% of the markets in a highly overvalued zone, or you could say there was some excess of froth buildup. As of now, based on our proprietary valuation indicators, only 28% of the market is still in the froth zone. So I could say with a lot of confidence that the froth or the excesses have come off significantly. And I think from a valuation standpoint, I don't see any major discomfort. Of course, in some pockets or very select stocks, there could be. As I said, 28% of the market is still frothy, but the bulk of the market is out of the froth zone.
Siddharth, what are your few largest positions, few of them, if you can talk to them,
So,
about them?
rather than being more stock specific, I will tell you how my portfolio is constructed in terms of it. It's a flexi cap strategy. So, how it's constructed in terms of its size mix and sectoral mix. So, I think right now we are at 80% concentration between large and mid cap, say around 45% large caps, 35% mid caps, and only a mere 20% small cap. If I go back a quarter, I think my portfolio was at 75% mid and small and only 25% large. So the color of the portfolio is changing. It is becoming slightly more defensive than it was, say, a quarter back. And in terms of sectors, I think the largest holdings continue to remain in industrials, which comprise of the entire cap goods, engineering, defense, railway, the entire pack, and energy and utilities. And we've just built a significant overweight on the materials and metals space. So we're now close to 15 to 18% in the metals and mining space as well. So I think between these three, 75% of my allocations gather between the industrials, energy utilities, and materials and metals.
Right. Let's talk about materials, because that has been trading under pressure for some time. A lot of M&A happening in cement. Today only we broke a story saying that the Birla Group actually may be keen in picking a promoter stake in Orient. We've seen some M&A happen. But what surprises me is that cement as part of the material space has not seen any price hikes for almost 10 years. The prices have been very narrow range. There are overcapacities. But at the same time, all the big guns in the space actually want to add capacities. Do you see
Right.
3-4 years down, pricing power come back, utilizations pick up, demand higher than supply?
So the only clarity on the whole cement sector broadly is that demand will be resilient, volume growth will be strong given the focus of the government on infrastructure, roads, and all the construction that's going on. And with real estate as a sector also showing tremendous volume growth and participation, I do believe volume side and demand side cement stocks should not have an issue. Given that in my portfolio, we don't have any cement stocks, it's all metals. And I believe all the metal plays are going to have a tactical benefit from the ban on Russian imports. At the same time, global prices increasing, given China is showing some signs of recovery. So I think we've taken exposure within the materials pack with the metal space and not the cement space at all. So we don't own a single cement stock.
So, what about capital goods? Is valuation not a challenge in capital goods stocks, or you are okay owning some of this capital goods stocks because there is visibility of business, even if they are
I
coming at
think
slightly
at a
steep?
portfolio level, what we are trying to do quantitatively is that we want stocks where there is a more clear growth visibility, the growth of those sectors or stocks which is relatively higher than their own past versus the competing peer industries and versus the broader markets. So we are very, very clear in terms of how we are positioned on the growth front. It has to be better than the past growth rate of that stock and sector, better than the other sectors in the market, and better than the broader markets. With that, we also apply a lot of valuation filters as well. So our portfolio tries to balance growth and valuations. And again, we look at valuations from a relative lens, not an absolute lens. So we don't believe a PE of 10 is cheap or a PE of 15 is cheap. We look at PE or PB or EV, EBITDA or any cash flow based valuation metrics from a lens of relativity. And given that, I think we are fairly comfortable with our capital goods and engineering exposures as well.
How are you playing the railway space? Is it via the EPC railway companies or wagon manufacturers, or what quality of names do you have there?
So right now we own IRCTC, and at some point we've been owning Ircon as well. But most of the other railway stocks don't fit into our portfolio simply because of liquidity or market cap filters that we use. So the only stocks we've owned is IRCTC and Ircon for the long time.
All right. We'll let you go on that one. Thanks so much for joining us on the show today. We'll take a short break on that note, come back and put the spotlight on the housing space. We'll tell you what are the drivers of